The topic of this video is to discuss the difference between investor interest and investor intent, and they are two different things. But before we get into this, let me give you some quick context. I've been raising capital since 2010, and over that time, I've sat across the table from hundreds of investors. And I'm talking high net worth individuals, accredited investors, the more sophisticated individuals out there, also institutional investors too, including family offices. And I've watched them all make the same mistake over and over again. Developers confuse interest with intent, and that's the mistake that they make. They think a good call means momentum. They think good questions means a lot of commitment from the investor. They think that if someone says this looks good, money is definitely on the way in. It doesn't mean that at all. And if you don't understand that distinction, your raise is going to feel pretty unpredictable, even if the deal itself is rock solid. So what I'm about to break down isn't theory. It's all about pattern recognition. This is what actually happens on investor calls at scale. So here's the core issue that it really boils down to. Interest and intent are just not the same thing. And confusing the two will be absolutely going to wreck your raise. And it's also going to be pretty expensive for you too. And it doesn't matter how good your deal is. Here's what usually happens. You jump on a call, investors get engaged, they're asking questions, they're nodding along. Then someone says something like, yeah, I like this. And you come off the call thinking, okay, that went well, which would be fair. Anyone would say that. But 2 days go by and you follow up and then there's nothing. And you're sitting there thinking, what changed? They were interested. The truth is nothing really changed. They were interested the whole time. And that's the problem, right? That's the bit that people miss. Getting interest is actually pretty easy. Investors are interested in everything. They are on the hunt, they're looking, and that's the problem. That's literally what they do all day. Taking a call costs them nothing. Saying this looks good costs them nothing. Downloading your deck doesn't cost them a penny. But here's the part people don't always think about clearly, at least in the early stages, that not thinking about this will actually cost you a lot of money. For example, we're running ads right now and we're spending around $100,000 a month on investor acquisition just for one of our sponsors alone, just one of the companies that we're raising capital for. And a qualified lead costs us roughly $300. That's $300 for a qualified lead. So all those clicks, if we find out they're an accredited investor, they're pre-qualified to at least that degree, that's costing us $300. And that's just to get someone into the funnel. Then you're relying on them to actually schedule a call on the next stage, right? And by the time someone books a call, you have some drop off, and that number is actually closer to $1,000 per booked appointment. And that's before the call even happens. Out of those booked calls, only about 50 to 60% of them actually show up. And that's with call confirmation calls. As soon as the appointment is booked, we have one of our associates contact them straight away and confirm the appointment for the following day and ask me if they need any additional information to fully prepare for the call. You've also, on top of that, you've got all the manual and automatic emails and SMS reminders that go out too. This is with tightening up the entire SOPs around the entire sales process. So by the time you're actually sitting on a live Zoom with a real human being, that moment is pretty expensive. There's lots of pressure, especially for the person who's on the call with the prospective investor. But for the prospective investor, it costs them nothing. For you, it took ad spend, it took a whole bunch of funnel optimization. There's design there, there's sales infrastructure, there's follow-up systems in place, there's calendar management, there's confirmation workflows. You've also had to embark on some sales training for your team and so on. Interest is free for the prospective investor, but it's just not free for you. And that's the key takeaway here. That's why you can't afford to confuse interest with intent. Half the time, they're just window shopping, to be honest with you. I can't tell you how many calls I've been on where someone asks, hey, can you send me the PPM? How are you structuring that waterfall? Who's your lender? What's the weighted cost of capital across the entire capital stack? And you're sitting there thinking, okay, this guy seems to know what they're talking about. And you think, this guy's serious. In many cases, they're not. Sometimes they are. But in sometimes, it could even be a competitor who's trying to reverse engineer your deal. And by the way, that happens quite a lot in this space. You'd be surprised if you haven't embarked on this before. If you've been raising capital for any length of time, you're going to know that there's a lot of people that actually just contact you. They pretend to be investors, and really what they're doing is they're trying to reverse engineer your offer. There's always people trying to get a hold of your PPM so they can tweak it themselves and basically save $40,000 on legal fees. Over time, you do tend to learn how to suss them out. Again, that's all centered around interest. That's an example of just people being interested. You don't know who it is. It's not intent to purchase or intent to get involved in your investment directly. And even real investors do this. We get a lot of people who genuinely invest in lots of different asset classes. They've got money. They've done deals before. They understand private placements and they know exactly how this thing goes. They've owned property. These people aren't typically considered tire kickers, but they are still fishing. And they'll tell you straight up. You might hear something like, yeah, I'm moving some money from an IRA to a self-directed IRA. What does that mean? Think about that. If I'm moving money from an IRA to a self-directed IRA, what does that actually mean? Well, it means they're pulling money away from a money manager. They're stepping out of stocks and mutual funds, and they're reallocating capital that used to basically sit in paper assets. And now they want full control. They want something perhaps that's more tangible. And so then what happens? They don't just look at you. They're looking at 5 opportunities at the same time. They're looking at real estate. They're looking at development deals. They're looking at private credit options, maybe gold, maybe silver, sometimes even rare rare earth metals, stuff like lithium and cobalt, because they like the utility angle perhaps. I've even seen people looking into investing into diamonds and gemstones. They're surveying the entire landscape and they're thinking, if I'm taking control of my capital, where should it be deployed? That's not a small move for most people, right? That's a portfolio shift, a complete reallocation. But here's a mistake people make when they're speaking to prospects like these. Just because someone is reallocating capital, it doesn't mean they're going to be reallocating that capital to you. They're doing their homework. They're comparing structures. They're comparing risk bands. They're comparing liquidity timelines. They're stacking you up against all the other options in a spreadsheet that you'll perhaps never see. And that's still a lot of interest. Granted, it's also perhaps considered serious interest, but it's just interest. It's not commitment. It just means you're being evaluated. You're one option, one comparison. You're one open tab on their browser, one PDF that's sitting in a folder on their desktop. But the evaluation feels like you're making progress, feels like momentum. But evaluation is not allocation. It isn't a signed subscription agreement, right? It isn't funds wired. And that's the gap, right? That's the issue. But on the other hand, intent feels completely different. Once you've seen it a few times, you can't unsee it, right? When intent is there, you'll know the difference immediately because the conversation changes. They stop asking curiosity-based questions. They start asking positioning questions, right? Instead of asking, hey, what's the IRR? You're going to get something more like, if I move 300K out of my existing IRA, how quickly can this settle? And when does my first distribution start, right? That's a solid question. Instead of who's the bank, you get, where does the bank sit in the capital stack relative to me? And if I have a second lien behind the bank, what legal recourse do I have? Instead of send me the docs, you're going to get, what's the allocation minimum? And how tight is the window? Can I combine funds from my retirement account along with post-tax money? Those are serious questions. They're not curiosity questions. They're decision-based questions. That's your signal for when a deal becomes real to them. Now, this is really important. I just used the example of an IRA moving to a self-directed IRA to illustrate my point, but it's not just IRA money. That's just one example. Some people are using post-tax cash. They've just built up liquidity over time. They've exited something recently and perhaps they've refinanced an asset and suddenly they've got a chunk of money that's just sitting there earning nothing and then they want to put that money to work. That's a different psychology altogether. There's no custodian, there's no administrator in the mix, there's no transfer paperwork, there's no retirement wrapper at all. It's just capital that's effectively looking for a home to grow. Then you've got the other group. You've got people in the 1031 crowd. It's a completely different animal altogether too. Sometimes they've sold a property and they're under a certain timeline pressure. Sometimes they're looking at your opportunity after they've done something really strategic, perhaps. Like we had one of those recently. It was a 1031 investor. They used a high leverage 1031 structure where they were able to effectively pull out a large percentage of their equity in a tax efficient way. We now have access to that mechanism, by the way. It's really very powerful. We're going to have a whole nother video for that. But I digress. In that example, we've seen investors basically free up 70, 80, sometimes 85% of their capital without actually triggering a tax event. And now they need to deploy it and they're looking to deploy it quickly because the clock is ticking. The urgency is real. And of course, urgency is good. But urgency doesn't automatically mean commitment, right? It just means that you've got a buyer in heat effectively. It means that they need to place capital somewhere quickly. They've got allocation pressure and they're looking for options fast. So you get the curiosity, but it doesn't mean you get the intent just yet. On top of that, you've got the conservative capital out there, right? Those people who've got post-tax money, no deadline, no forced move. They're already comfortable in asset classes they already know, like multifamily deals, for example. They know the asset class they like. Maybe they've owned apartments for years. Maybe they've invested in syndications before. Now they're looking at perhaps maybe adjacent verticals, maybe development, maybe land, maybe something that sits slightly higher on the risk curve, but it's still sort of inside the space that they understand. They're sticking with real estate, for example. That conversation, again, feels completely different. When we talk about the qualification, it's not just, are you interested? It's, where's the money actually coming from? Why now? What's triggered this move for you? Are you under any kind of deadline here, or is this flexible for you? Is there a tax situation that's driving this? Is there something in your portfolio currently that's underperforming, or is this just cash sitting there that you want to have work harder, right? Because intent shows up differently in each of those different scenarios. And if you don't understand the source of the capital, you can't structure the path to deployment of that capital, right? You end up just playing the guessing game, and guessing tends to kill momentum as a whole. And here's something a lot of developers don't quite understand for the most part. When intent starts forming, the call gets heavier because they're thinking in allocation terms. Do I move 250K or 500 grand? How does this show up on my balance sheet? That's not disinterest. That's silence. That's slowdown. That's the moment that things become real for the investor. That's when they're no longer evaluating the idea. They're evaluating the consequences of actually taking that next step. That's a bit bit different. And if your raise isn't built properly, like if there's no clarity, if there's no structure, there's no clean next step, you'll find those same high intent investors start to back off. They start to retreat because there's no clear next step. If it doesn't feel like this raise is actually moving somewhere, your intent is going to start falling apart. This is why we don't just send the deck with a Dropbox file full of diligence. On a real call, we'll say, okay, here's how this actually works. And here's how previous funds have actually performed over time, etc., etc., etc. Because until they can see the structure clearly, they're not going to be allocating. They're just going to be browsing. And I'm not doing that to sound smart. I'm doing it because once they can actually see how the deal works, the fog, you'll find, will start to clear up. And when that fog clears up, you'll find that they either move forward or they don't. But at least it's a real decision. This is also why follow-ups don't work the way people think they do. You can't chase interest into intent. You can't send more emails, more decks. That just kind of restarts the curiosity clock. You're just giving them more features, more benefits that re-engage their attention, sure, but intent, as in the intent to move forward, only shows up when waiting feels uncomfortable and acting starts to feel safer than just sitting still. And that usually comes from clarity around allocation minimums, real funding milestones that actually mean something, seeing and speaking with other investors who are already involved. I'm talking about the things that relate to this structure of your opportunity, because structure creates intent. Sales pressure alone rarely works. And that's the part that not a lot of people like hearing. The job of capital raising isn't just to get people interested. You've of course got to get people interested to some degree, and there's a degree of generating excitement which is important to keep someone's attention, but getting that attention and interest is just the starting line. It's not the finish line. The real job is to force clean decisions from your investors, not aggressively, not manipulatively, I mean structurally. And once you understand this, you stop getting excited about great calls. You start watching behaviors, like did they ask about allocation sizes? Are they asking about when funds actually start to move, what they'll be signing next, where they sit in the capital stack? Or did they just ask for your pitch deck? That's the difference, right? As you can probably tell by now, it's a big difference. I see people mistake interest for progress all the time. Sponsors will tell me they've recently launched their capital raise and they say things like, we're getting loads of interest. Okay, that's cool. How much of that actually converted into signed subscription agreements? How much money actually moved? Did they commit to a number? Did they commit to timing? Did they commit to the next action? If nothing actually happened, you just had a good conversation. And I get it. That's annoying because interest feels good, right? It's flattering. It makes you feel like you're onto something. But intent is the only thing that actually moves capital. And intent only shows up when the opportunity becomes specific to that investor's actual life, their portfolio, their liquidity position, their exposure, their risk tolerance, their timing. And that's when money actually moves. Not when they say it sounds interesting. Interesting feels good, but intent is what actually reallocates live portfolios. And if you don't design for intent, raising money is always going to feel harder than it needs to be. So if you're a developer or sponsor watching this, this isn't just about improving your calls, your sales calls. This is about engineering your raise properly before you ever get on one. Most people try and fix this at the sales level, and that's not the right thing to do. They train their teams harder, right? They chase follow-up calls harder. They send more decks. That's not the fix here. The fix is actually structural. Your positioning, your capital stack clarity, your risk communication, your allocation mechanics, your closing process. If that's not engineered properly, you'll keep generating interest and wondering why money's not converting over. So if you're serious about raising capital properly, not just generating conversations, there's a link below to a platform that we're building for developers who want to actually get ahead of this before their next raise. It's where we break down how your offer is positioned with a certain type of investor, the specific demographic you're after, how to structure your deal with the correct wrapper for that particular investor demographic, how to strategically position yourself in the market. We're going to be talking about investor qualification, investor psychology, all of it. Because once you understand how intent actually forms, you stop chasing capital and you start directing it.